Hi everyone, hope you're all doing well, and today I'm going to talk about the 4 stocks that I'm buying or have bought already in December 2021. So I'm going to go through these 4 stocks, do a little bit of a deep dive onto these companies and why I've been buying them, so we'll take a look. Now just to let you know, Free Trade are currently doing an offer, which is if you sign up through the link in the description, you get a free share, and that free share is worth a minimum of £10. Now they sneakily took it down to £3 a few weeks ago, but right now going, I think it's to the 14th of December, if you join up through Free Trade, you actually get a free share worth a minimum of £10. As well as that, if you do want to buy stocks when I'm buying them in real time, make sure you join the Patreon, link is in the description. Join through there, you get my buy and sell alerts in real time, as well as 2 exclusive videos a week. But we'll get stuck onto the 4 stocks that I'm buying, or the 4 stocks that I bought last week to start off December. So this was the first kind of week where I had to start prioritizing what I'm buying. So the last kind of few weeks I've just been going, oh, this is down, I've been buying that, and trying to get some good averages on a lot of them. Now the problem is now that the dip has been going on for quite a while, that I actually started to look at the cash pile and go, that cash pile is starting to drop a lot, and it came to the point of view where I had to start prioritizing my stocks and which ones I buy. So I went for 4 stocks here that I believe are probably my strongest conviction plays, the ones that I look at and go, there's a lot of upside in these, as well as that stocks that I looked at the share price drop, and when these stocks in particular have also dropped a lot, so my conviction is very high in them. The share price drop has been massive on them, and also the potential upside on them I thought is massive as well in the next kind of 5 years. So with all that coming together, I thought these 4 stocks right now are probably my 4 that I really want to be buying on these dips. Of course they're going to be small market cap growth stocks because that's what's been hit a lot recently, but yeah, we'll take a look at these. Now the funny thing is this weekend it was kind of a weekend just to kind of look back into stocks, kind of make sure that, okay, what's going on here? Is this dip justified? No, let's just keep buying it. And it was a bit of a weekend to regroup after what's gone on with the stock market over the last few weeks. But as well as that, it was a bit of a, just looking back on previous stocks where there's been a wobble and you think, okay, that's the reward from holding through that dip on a previous stock. And I also looked at one stock that got away from me, the one stock that I always regret not buying, which is Shopify. I do currently own shares in Shopify now, probably 3-4 years too late, but I do own shares in them. Now, one thing in particular with Shopify is that this was a stock that was absolutely on fire, and I knew this was going to be a really good company, and I never bought it. One of the big reasons why I bought it is because I always argued, okay, the valuation's really high on it, but as well as that, there was always the negativity of that it's a company that loses a lot of money. Why buy this company? Go, buy, profit companies. Companies that lose money, eventually will catch up to them. And it got to me a little bit. It was the first time I've listened or let other people kind of affect my judgment on buying or selling companies, and I learned from it. You always do learn in the stock market, and this was one of mine. And Shopify was one that, May time, it was doing okay, and then pretty much through 2018, the stock really didn't do anything. In fact, you could have probably been down on your positions quite a few times, potentially even 16%. And that was a 7-8 month period where the stock really didn't do much. In 2018, you could argue the stock really for most of 2018 didn't do much. You were down on it, and it would have been one of those stocks that you're a bit fed up of, like, oh, I've been in this for a year, hasn't done anything. I'm a bit down on it. And a lot of people, what they were saying is just focusing on the company and looking at the losses they were doing. But if you look past the losses, at the time this company was growing unbelievable. The revenue on this company was growing 50+%. And what a lot of people were doing, or the negative people, were just looking at the valuation going, it's really overpriced. They were looking at the losses going, oh look, it's losing even more money now. But in this time, people weren't realizing that when you look at the company, the revenue was growing a huge amount, and what was going to happen is the sales and the research and development, the G&A, all this that was slowly creeping up, at a point it would get to where Shopify will be able to turn this a profit, and the revenue would still grow huge. It will level out with the cost of revenues and the operating expenses, and eventually, sure, in 2018, this is Q3 of 2018, you look at this and go, this is a quarter where they've grown revenue and losses are a massive compared to what they were a year before, but they're still moving in the right direction. This looks very similar to a few companies right now. And if you judge the company not off its potential, but over 2018 share price or the losses that were increasing, in a few years you would have then looked an absolute idiot. And that's what I looked. I looked an absolute idiot because I let them people who were negative on the valuation, the people who were negative on the amount of money the company was losing, and I let them kind of take over and kind of put me off buying this stock, given that I knew this was a really good opportunity. And with me doing that, this was a stock that I identified as being a really good buying opportunity. And this, depending on exactly where you might have bought it throughout the year, but this stock is up a massive amount since then, and this is only a 3-year period. It's up over 1,000%. This is a 10x stock in 3 years, and I just want to start off with that, saying this is a bit of a history lesson on a growth stock that loses money. Concentrate on the business, where it's going, the growth of the business, and you'll do okay. And this is one that I always like to keep reminding myself of. So number 1, DraftKings. So this is actually the stock that I think is the first stock I've seen that has the potential of a Shopify. This is the first stock I've looked at and identified this could be the likes of Shopify in 2018. And it's one of those that it might look a little bit frustrating on the share price. You look at where it was at the start of the year, where we came into the start of the year, and where we're at right now. We're down nearly 37% when you look at the progress this company has made. This company's going to grow 100% revenue rate this year, and it is down that much. It's one of those that it is not great while you're invested in this and seeing this all drop here. But the thing is when you're going from $60 or $50 down to $30, if you are a true believer in the company in the next 2 to 5 years and not where it's going to be at the end of the year, you're probably looking at this going, this is a really good buying opportunity. And it's the same for me. I'm looking at this one right now and thinking this is a really good buying opportunity in DraftKings. And even though I'm down on this position, I just keep buying it because I think the potential of this company going forward is massive. Now the company is currently 11.5 billion market cap, and you can see here the revenue growth that has been going on. Now obviously the losses are quite steep on this one, and it's one thing that it took me a while to get over the losses on this one, but when you do realise, and we'll talk about the losses in a second, when you realise you've got to take that market share and then it matures and it will go into profit, it's just part of the game really. And it is one of those that does look quite big on the losses, but in the long term it will turn itself into profitability. But what you'll see is the amount of revenue growth here that is going on. From last year when we were valued at $50, 614 million, we're now going to do about 1.2 billion this year, and going forward analysts are expecting 1.8 billion. I generally think that we could be pushing 2 billion next year. Now, if we do end up doing about 2 billion next year, currently at a market cap of 11.5 billion, that's going to put us probably around about a 6 price sales ratio, which isn't too bad for a growth stock that is growing at this sort of rate. And the thing with DraftKings as well, it does have quite a fair bit of cash on there as well at the moment, so we don't need to worry too much about that. And in the ownership side of it, there's been a lot of insiders buying on this dip, which is what you want to see. And going back to the part which a lot of people use against DraftKings, which is the losses. So what you have at the moment is that you have a lot of states coming online. The states, what you do is you go online, there's a lot of competition there. What you do is you pump out a lot of marketing, you get them customers, and then what will happen is them customers stay with you for the next 40, 50 years, and whatever marketing costs you put into that new state, you'll bring them back in basically over a long period of time. And this will happen for a while as more and more states come online, as it has just been allowed, and it's a massive time going forward. And this is a little an image from New Jersey, and basically this is what will happen eventually. And this will happen with all the states. So New Jersey is one of the first states that they launched. So you look at this launch year, August to December, made revenue, lost a bit of money. Year one, they have their people they gained in 2018, and then you had the 2019, same again, losing money. 2020, you'll see here that they then make revenue of this much to all the new players coming in, and then we start contributing to some profit. And then if we look at this year, what they're expecting, you can see here that we have the new additions coming in. So you can see that this is quite a bit of a mature state. You can see that the revenue from the state will still grow from 153 to 210. That's still really fantastic growth. But then that contribution on profit will jump up a huge amount as well, because what will happen is marketing spend comes lower and lower in that state. And a lot of these people you have from the last kind of 3 years, then basically there's no marketing cost for them because you've acquired them and they keep putting positive cash back into it, and there's not as much marketing spend. So when more and more of these states mature, like New Jersey, you can see this is the path to profitability for DraftKings, is that the states still grow at a really good rate, you don't market it as much, and then that actually starts contributing to really good amounts of profit as well. And you just imagine that over more and more states. This is how New Jersey is the example of more and more states will still grow at a really fast rate, and as well as that, they'll start contributing to profit like how New Jersey is. So I won't spend too much more on DraftKings because I've got plenty of videos on the channel, but I thought that was just something just to add in there for you guys that come and watch the videos all the time and watch DraftKings stuff. I thought that was a really good chart to show the path to profitability on that one. So number 1 is DraftKings. Number 2 is Hims, which is a telehealth service, so very much like number 1, massive TAM growth going on. Number 2, especially what has been in the last few years, has really fast forward telehealth services, and going forward I think telehealth services are going to be huge. Hims is a bit more of a smaller player in there, but the rate they are growing is pretty impressive, so I did pick up a few more shares in Hims. Hims is a stock I've been watching for a while, and eventually I've been tracking it pretty much a lot of the year, and I saw it going all the way up from $24, and it just kept going lower and lower as the year went on, and then it went into the single digit range, and then when I saw Hims actually start touching this $8 range, I thought, okay, this is probably time where I start picking some shares up. So I'm currently down on this position, but it's a very new position for me, and I'm trying to build this position up in the next 12 months. But I think this is just a very good chart to show that this came through a SPAC originally, and you can see that it did get all the way to $24, and now it is massively down, even below its SPAC price, which is bonkers because the progress this company has made since coming through the SPAC has been huge, and it's even half the price that it was over a year ago. And the progress it has made is this. Look at the investor presentation. This was a brand new company in 2017, 27 million up to 83 million. I mean, look at that for really good growth as well. 138 million, and then 179 million, and then 223 million. Just put into context, 179 million. If we just look at what we're actually planning on doing this year, we went from 264 million to 350 million. And then at the end of 2023, 444 million. So even the numbers that were in the presentation of the SPAC are just massively being smashed out of the water. I mean, you could say the sandbags at 30%, but yeah, we're growing even faster than that. Made some really good acquisitions in that time. And as well as making loads of major acquisitions, partnerships are going strong with Urban Outfitters, Uber, the marketing side of it, and especially expanding with Walgreens as well. Like I said, all this progress of beating expectations with revenue growth, partnerships, share price not really showing it as well. And it's not like even this is at 1.15 billion with 80% revenue growth, potentially doing like 300 million in revenue. I mean, the valuation isn't even crazy. And people say, once again, is there a path to profitability here? Well, you look at the revenue here. I mean, just look at the jump here on the latest quarter. Look at the cost of revenue as well. You're doing 74 million. Your cost of revenue is 90 million. So your gross profit's 54 million. So you're making 74% of gross margins, which is absolutely amazing on it. You look at the expenses at the moment, which is marketing at 38, selling general and admin at 44 million. So your expenses are 82 million, which has been a bit of a jump here, which is basically what is causing, a majority of the losses here. So this company's point of view is here, this company could with these margins here, this company could easily do profit. But the problem is like, do you want to grow at 80% or do you want to grow at 20%? And that's the big thing. So this is more focusing on taking a lot of the market share, and in the longer term, this will lead it to do profitability. As you can see with margins, if they really wanted to, they could, have the selling, general and admin or the marketing costs, and this would easily get to profitability, but it's more focused on taking that market share, growing at the rate it is doing, and I would rather the company do that than slow down this growth here. So for me, I'm really happy with what it is doing, and any concerns about losing money, I don't think it exists with this one. Financial health, it's clean on the balance sheet. It's got 252 million cash, which is a lot for a 1.2 billion market cap company, and it is founder led from the last kind of 4 years. I mean, don't forget this company's only been around for like 4 or 5 years, and it's already done all this. But the co-founder is still one of the biggest, CEO, co-founder, one of the biggest shareholders in the company, which is what you want to see as well. So number 2 is Hims, and number 3, of course, would come on this list is Gang. So Gang is currently a $9.16, and it has had a really bad year. We're looking at the share price once again. You look at this here and you think, it's a company in the last 2 years that's not made any progress. But if I tell you this company's grown its revenue by like 300%, you'd be like, hold on, the share price is down this much and it's grown that much. Okay, this is somewhat going on weird. And this is for me, like, once again, this is a prime example of a company that I think is absolutely amazing and firing on all cylinders and just going cheaper and cheaper. I'm going to keep buying it, and I think this will do very well in the next few years. And this was the last earnings report. You'd think there'd be something in this earnings report that screams like there's something bad going on here. But once again, you can see here that the revenue growth, 214%, it beat on there. A little bit of a loss, but that's fine, because as we know going forward, it's the big thing is growing that revenue, which it is doing. And it's got no debt on here. It's expecting 225 million to 135 million. And at the start of the year, we expected this to do about 100 million. So this is way outperforming expectations right here. And the great thing now is we expect our profitability to continue to trend positively going forward as we build additional business scale. So this is a big thing, the big investment to grow the growth here has been done now, and it's coming in. You've seen the rewards, and now as well it can go back to focusing on profitability, which it used to do, which is you're now getting a company here that is very clean on the balance sheet, potentially starts doing profit next year, amazing, really good revenue growth, cheapest valuation it's ever been. It's a screaming buy for me. And this is Gang on Y charts, which is allowing me to go on this one. Same again, I'm still freeloading at the moment, so sometimes I can't go on everything on Y charts. I generally did ask them saying, can I have a free Y charts? And they said, and I told them that, I'm showing it off to so many people on YouTube, and they're like, yeah, you can have it for cheap. I was like, okay, what's cheap? And it's like $3,000 a year. I was like, okay, that's not happening right now. That's going into a stock called Gang instead of that. So I am working on it, but we aren't getting anywhere just yet. But Gang, going back to the stock, Gang PS ratio down at 3. I mean, look at this. The minimum it has ever been, or the lowest it's ever been, we're currently having right now. The maximum was 24, believe it or not, in February time, and the average is 12. So I mean, even it's nearly like 3-4 times below the average price to sales ratio, which is just absolutely bonkers. And you look at the progress the company's made as well. And management have reacted to that. Management have actually started doing a 5 million share buyback because the stock is that cheap. Personally for me, I'm not too sure, because I think this is just to keep shareholders happy. I don't think they needed to do it, but that's just kind of shows you how cheap it's got to right now. And you can see here, this is what the predictions go forward. Still really good revenue growth. They are just looking at just a slight loss on the list. Like I said, don't be too surprised if they do turn it into a little bit of a profit. Got a big thing for like a lot of Gang and DraftKings is Q4 and Q1 are normally the best quarters as well. So that's something to consider. And you see 2 years down the line potentially making a profit as well. So number 3 was Gang, and number 4 was one of my last highest conviction plays, which you probably could have guessed would make its way onto this list, which was Boohoo. Once again, Boohoo's getting tied into this kind of growth sell-off that's going on. Don't know why, because it does kind of make profit unlike the other ones, but still that does not seem to matter. You'd think something has terribly gone wrong with Boohoo once again. Look at where we were at February time, and boom, we're down 56%. Like I said, this is a profitable company, and you're probably looking at this one thinking there must be something majorly wrong with this company to be dropping that much. But once again, I think this is a really good buying opportunity, because I think if anything, it's only got stronger. Now, it did let me onto Y charts for the P ratio of Boohoo, and you can see here it's currently down at 34. Look at the history of the P ratio of Boohoo. I mean, just look at that. That just says everything, really, doesn't it? The average P ratio is currently 64, with a minimum of 34, which, once again, yes, it is what it's at right now, and a maximum of 121. So it is about twice below its average right now, currently. And one thing that people aren't realising with Boohoo is that it has dividends coming in. Dividends will be a big thing for Boohoo in 2022, which it will start relaunching. That sales will come in, and also the beauty side of it as well. Obviously, Boohoo's never had beauty before, and that's going to be something that comes in. And also really interested to see that they made a store of Debenhams again in Manchester. I think this is probably a really good move. I would really like to see them potentially put up a few of the locations. Obviously, they'll know which locations were successful previously. If any of the locations were really successful and bringing profit in, I would really not mind Boohoo to bring in some more physical stores again, because I think it does really work well with some of these stores having physical locations. Likes of JD Sports, a fantastic company, a fantastic stock, and that has the combination of both physical stores and online presence. So yeah, I think this is a really good move from Boohoo going forward. And just going back onto the stock chart, you see this stock has basically, not really done anything through 2021. But I mean, just look at the progress that it's made, really. If you go from, let's say February 2020, 1.2 billion to February 2022, 2.1 billion. So, you know, you're talking a massive jump. The revenue in 2 years, the revenue's nearly jumped in this company. The profit is down slightly because of, well, it is up still a little bit. It isn't as much as what it was because margins have been shrunk because of logistic costs. I think that will sort itself out in the longer term. And then that P ratio will be even lower than, say, a whatever it is now, 35. I mean, that will probably knock it down all the way down to a 17, which is, you know, crazy low for a company like this. I mean, the sales are 2 billion, the market cap's 2 billion, all the metrics are screaming out this is an absolute steal right now. Like I said, just look at the growth here. You don't get many UK companies at this valuation that have this growth, this profitability, and financially as well. I mean, just look how strong it is financially. You know, a really, really clean balance sheet on here. So number 4 is Boohoo, and these are the 4 stocks that I bought last week. I will probably be focusing on these ones a lot more because they are my highest conviction plays at the moment, and also the ones that I look at and think of the share price, that how much they're down, and the potential upside on a lot of these stocks. You know, all these stocks here, obviously I expect to have at least double my return on in the next 5 years, but I generally look at a lot of these stocks and I would not be too surprised to see a lot of these stocks potentially putting 3, 4, potentially with a few of them 5x returns in the next 5 years. So yeah, I thought I'd be buying these ones. So I hope you enjoyed me sharing and keeping that transparency up so you guys know what I'm buying. Let me know what you've been buying in the comment section. Hit the like button, subscribe, and I'll see you in the next video.